that asset manager could be involved. Potentially the regulator could be involved and receive some part of the transactions. That has a main benefit. Of course, the first is privacy. Only the entities involved in a given transaction are aware of the details of the transaction. It also provides the ability to properly supervise. As I said, some subset of the data could be sent to the relevant supervising entity. So if it's a US security, it would go to the SEC. If it's a European security, it would go to the European regulation. There will be no full transmission of the entire data to like an omniscient database. And a side benefit is scalability, which is important when we're talking about institutional financial markets. With this data segmentation, it's easy to parallel process transaction. You can imagine that entity C would trade with entity D at the bottom at the same time as A and B would be trading. This is not really possible in the fully replicated model when you need to wait the entire network to have reached consensus to process the next transaction. So the scalability in terms of parallel processing is pretty strong with that model. And in addition, in terms of data storage, if you think that you have to store all the transactions everywhere, this becomes a very challenging data storage topic. Imagine that you have the Netflix catalog of movies on everybody's computer. That doesn't really work. And to continue kind of demystifying the technology and how do you provide blockchain with privacy, I'm giving here an example of how a smart contract looks like when you implement privacy. The top part are the terms and conditions. So you have the name of the asset called asset. You have who's involved, the issuer. You have some identifier, let's say a QSIP and ISIN, maybe the coupon rate of that bond. So that's the top part, description. The middle part is kind of who signs, who observe. Think about DocuSign. It's the people who sign the contract and the people who receive the copy of the contract. So you define here who are the parties that are able to act on the contract. And the bottom part is kind of the life cycle. What action can be done on that asset? Here you can see a transfer action is possible. So you can transfer the asset and you define who can do it. Who controls that transfer? The controller is called the owner. So whoever owns that asset at that time is able to transfer that asset. And who's informed? Maybe the regulator is an observer and can receive a copy of the trade details or a subset of the trade details. So I'm sharing these fairly technical trade details to show that migrating to blockchain with privacy is not that difficult. It doesn't need a complete big bang on the industry. The smart contracts are very similar to term sheets. The privacy can be maintained so that the asset manager, the treasurer of a corporation, and the regulator can be informed of their trade and only their own trade, or the regulator is informed of the trade that are under their scope. And so to recap, if we look at the two models I presented, the first one is really strong when you do full replication, when you have a censorship resistance need, and when you're fine with having full transparency. The fully replicated model is perfect when you're creating digital gold or Bitcoin. It's kind of the Napster analogy I made earlier. The second one, where the data is segmented, is really well suited when you need privacy and a granular supervision of who can see what, where the data is stored. That segmented model, in that case, in my opinion, is more appropriate. Now I'm going on to the section of where do we stand in terms of adoption of blockchain, specifically for regulated assets. So if we take the big picture of the crypto industry, you have like 3 trillion of crypto assets. The biggest part is Bitcoin, ETH, who are like censorship-resistant currencies. Then you have a subset of stable coins, probably 300 billion of stable coins that we discussed before. But if you look at the securities, the treasuries, the bonds, the funds, you see that the top 4 chains, 3 of them are privacy-enabled chains: Canton, Provenance, and ZK Sync. And I think it's not a surprise. For assets that are regulated, privacy matters, and these are the chains that so far have been able to tokenize these assets. So to conclude, when it comes to institutional use cases, I'm really convinced that the broader adoption requires a blockchain that provides both privacy and also is able to allow regulators to prevent abuse, such as front-running and insider trading. I think that the fully replicated blockchain model, the Napster model, is great for censorship-resistant use cases like BTC or Zcash. But I think for regulated markets, such as US securities, a segmented model, the Spotify approach, is better suited because it can provide privacy and also the compliance that is required. And so consequently, the blockchain that so far have been able to provide privacy are the ones that are starting to be adopted. But as we saw, like these few hundred billions is still a small fraction of the trillions that are traded every day in the market. And so we still have a very long journey ahead of us. Thank you very much.
Thank you. Thank you, Simon. I think what we're going to do is we want to make sure we have time for Q&A, so I won't keep asking questions. Unless the audience has a question now for a speaker, you can ask. But what we'll do is from here on out, we will have questions. We'll have Q&A at the end. So I'm going to move us right on to our next presenter, Nikhil Raghuvira. And Nikhil is co-founder and CEO of Predicate, a blockchain infrastructure company built for programmable policy enforcement, and a senior fellow at the Atlantic Council's Geoeconomic Center. Nikhil, it's on you.
Thank you. All right. Looks like everyone can hear me. Hey, everyone. Nice to meet you. I'm Nikhil, co-founder and CEO of Predicate. Thanks, Yaya. And thank you, everyone, for being here, and thank you to the SEC for hosting this as well. All right. So what I'll be talking about is on tokenized securities, right? We're at the SEC, so I thought it would make sense for us to talk a little bit about how that might be possible. All right, so I think some of the core fundamental pieces really for how we should be thinking about a tokenized securities market in the first place when it comes to blockchains is first, of course, it being issued on a blockchain, right? That's where we have to start from. Another part is essentially smart contract
Justin, good to see you, brother.
right?
Ultra Justin, thanks for tapping in.
The ability to actually have programmatic execution for a transaction requires smart contract functionality when you think about a marketplace. You also need observability, which of course can run counter to what we're talking about from a privacy standpoint of how do you actually ensure securities in which there might be some observability that's required as necessary to meet securities obligations. And then of course the last piece is around how do you actually set rules for who can interact with the primary market issuance of a securities market. And so it actually comes down that privacy is critical for the adoption of tokenized securities. And I think folks have actually already been talking about this the entire time, right? So how do you keep trading strategies to be proprietary? How do you ensure market integrity? How do you prevent front running? And if we look at live blockchains that enable full privacy, it would be folks like Alio, as well as Canton. But then I think this is where we have to start really thinking about the more complex part, right? So a regulated market, if you're going to build tokenized securities, really requires permissionless infrastructure. And I want to emphasize that. If everyone walks out of this room and thinks that, oh, great, you should have tokenized securities on a fully permissioned system that is centralized, that would be the wrong takeaway from this talk. The real thing here is actually that it should be built on permissionless infrastructure. And there's a reason for that. And I think some of this text got disappeared at the top. But the first part is that when we really think about it, permissionless infrastructure allows for interoperable liquidity across jurisdictions. Really what we're talking about here when we talk about blockchains is a global system, right? It's not one that is centered around one specific group. Rather, how do we have an entire system that is able to operate globally? No different from HTTPS, as Ko talked about. That only works if you have a permissionless system. The other part is we've talked about the importance of self-custody. And again, a permissionless system allows for that. And then lastly, the programmability, right? So when we think of programmability, it is really for the aspect of open innovation. The moment you have closed systems, you don't allow for that open source innovation that is really where blockchains shine. And this is the same for decentralized finance. So it's an important point here to consider that it's both about blockchains as well as a decentralized finance. And so examples of this in real life are Ethereum, Alio, Uniswap, Aave, a lot of these different groups that are building both open blockchains as well as open financial infrastructure. So then when we turn to securities, how this can actually work for securities is custom interoperable applications that operate on top of permissionless infrastructure. You're not replacing them, but rather you're thinking about how you can build on top of permissionless infrastructure that sits there. The best example of that is actually what Uniswap allows you to do. So that you have the Uniswap protocol that is a permissionless decentralized exchange. And then they built systems called hooks. Hooks allow you to set custom requirements for new types of applications that sit on top of the Uniswap infrastructure. And that's really important because now you can have Uniswap that I can go and use for a different use case that has nothing to do with securities. It can be entirely for commodities. A different group in India can use Uniswap for a completely different use case. And then someone in the United States who's thinking about securities can use Uniswaps for their specific use case without affecting me or that developer or that organization in India. That's really important. And then the same thing you can do, given that you have open source technology, is when we talk about a new application, you can also fork that code and create a custom implementation. And so a really good example of that is what Aave has done with Aave Horizon. Aave Horizon allows for securities to be used within their system, but it is a separate instance. And so other groups that have been using this type of infrastructure is Denari, for example, on tokenized securities, as well as Plume, who's building custom vault infrastructure as well. So again, the important part here is all this operates on top of decentralized infrastructure. And so how this works, to actually show a diagram, is here you have a front end, and then you have a USDC paired with a tokenized security, which sits independent of an Ethereum USDC pool, which can sit independent of a Solana USDC pool. So again, these can all coexist, all of this because you have common infrastructure. If you don't have common infrastructure, this breaks down. Then we get into the next part. So how do I, if I'm creating a tokenized securities market, set rules for, hey, certain users should not actually be able to access this because they need to be accredited investors. They need to be an approved institution. And so that's when we come into programmable policy infrastructure, which is where we specialize as well. And so this can also sit on top of DeFi at a smart contract level. And so here, essentially, you have a financial application that utilizes policy infrastructure that sits off of the blockchain, that is called via an API. And then it's enforced at a smart contract level. So every transaction is enforced to ensure that only an accredited investor can go and buy that tokenized security. So when you pair that together from the earlier image, you now have a specific USDC tokenized security pool in which only accredited investors who are, KYC or KYB have the appropriate requirements, are allowed to buy a certain volume, all of those things. You're able to essentially set those requirements. And again, this has no effect on the Ethereum USDC pool or the Solana USDC pool. And then the last part here is actually when we think about the different identity systems itself. And so this is where there's a really unique opportunity when we think about the fact that you have zero knowledge proofs and the fact that I shouldn't have to disclose all of my information at once, right? So my investor accreditation is something that I should actually be able to provide via zero knowledge proof. I should be able to show that I'm over a certain age. I have various requirements met. That can be paired with zero knowledge proofs. But then there's going to be plenty of things that don't involve zero knowledge proofs, or there'll be certain organizations that say, look, like you have certain information, we're going to store that privately. And I would imagine many fintechs might be thinking of it in that world. And so again, you should actually be able to pair both on-chain zero knowledge proof identity as well as off-chain data systems together. And then the last part, of course, is, again, you have data sitting on a blockchain as well. If a user has self-custody over that, they should be able to provide certain proofs of that information. Again, all of these pair together to be able to say, hey, look, I am someone who has a right, who has the ability to be able to buy this tokenized security. And an example of a group that's been doing that recently is someone like Aztec, who has incorporated both zero knowledge proofs as well as off-chain systems for more regulated activity. So all of this, again, is real. It's not something that's theoretical. This has all been done. And so then we can pair that with another diagram, of course, here, which is I'm an investor who has a wallet. I go on a front end and I said, hey, I want to buy this security. And I need to go and submit my investor creditor information. I can do so. And that could be either I already hold a zero knowledge proof of it, I can generate that, or the asset issuer, the broker dealer, can say, submit your company information, right, to show that you are based in the United States, that you meet our requirements. And if they do that, they're then able to go and say, let me go and buy this asset. And so that's when you can actually pair all those different pieces together, which is you can start from the beginning, going from no accreditation to getting accreditation, having the right requirements, and then being able to participate in an on-chain securities market to be able to buy a tokenized security, all while ensuring that it operates on top of a permissionless blockchain in a privacy-preserving manner. And so to recap, adoption of tokenized securities requires privacy. It's absolutely essential. And it requires permissionless rails. None of this will work without that. And I think the other part here is that we have the opportunity to be able to utilize more and more data that is self-contained, that is held by us for privacy-preserving reasons, but also to be able to incorporate any other data that is not quite there yet for things that are not fully private, that sit within centralized data companies. Those can also still be available. And lastly, all of that can be paired together for real-time enforcement in a programmatic manner. And all of that is possible today, in which we can have on-chain privacy and programmable compliance in order to unlock real-world adoption of tokenized securities. And so with that, thank you very much.
Thank you. And to round up our speakers, let's bring up Wayne Chang. And Wayne is founder and CEO of Spruce ID, whose mission is to let people control their identity and data across all their digital interactions. So Wayne, we're going to let you round up the speaking, and then we'll have a Q&A and prepare for the next segment.
Thanks. Super grateful to be up here. Thank you so much for the task force for having us. I'm going to be talking about a lot of these components that we went over about the next generation financial system. Why is this important to Americans at all? Well, I think that making sure that everyone has access to an opportunity to prosperity is critical. It solves a lot of problems, and it can revitalize the middle class and a bunch of things important to Americans. So I think that ownership is one of the fastest ways to that and the most tenable ways to that. So if we can reduce friction around that and also get rid of all the fraud, all the waste that we see in terms of money going to bad actors and all these other areas, right? This is why it's really important and why I'm grateful to be here. So basically, we want to have systems that are secure. We want them to be usable. We want them to be accessible for people so that you're not discriminated against based on things that are protected, like your age, your beliefs, et cetera. It needs to work for everyone. And also, it needs to be seamless. People have learned to expect a certain level of user experience. To be able to use your phone and pay for things, everyone has that experience, right? Why is it so antiquated in other parts of the system? This is a big opportunity to modernize how we do business. And I think that there are bigger security problems related to how the financial industry and just in general identification works. A lot of these have to do with identity. You've heard that over and over again about digital identity. And think about how collection happens today, right? If you are trying to open a bank account, sometimes you have to hold up your passport to the webcam or your driver's license. You might even have to do that for fast food delivery or anything else that you do in the world, right? So a lot of the protections that are built into the physical identity cards are not meant for the digital world. The holograms that flash when you move the card around, how it bends, all the other features, right, that are built in for physical in-person inspection, that doesn't work when you're just taking a static image picture over a webcam, right? So a lot of these models can now also be generated by generative AI. So AI can generate a picture of you holding your driver's license or your passport, right? So it's really hard to understand if that's authentic or not. And I think that even worse, a lot of these things are collected in one central place, right? Only to be hacked. You can look at the news articles about how pictures of passports, driver's license, and et cetera are all just revealed on the dark web because someone got breached, right? And all that data just went out there. Now attackers and fraudsters can use that information, create synthetic identities in your likeness, and ruin your credit or any of these other horrible things, right? So the model was basically adjusted from a paper in-person world, and we've overstretched that to the digital world, right? So as part of modernizing the financial sector, we have to look at what do we build that AI can't destroy when used in the wrong hands? And with the proliferation of open source models, the wide availability of compute through AI factories, it's going to get more and more severe with these attacks, right? So we have to build the new world on security mechanisms that AI can't break. Things like cryptography, things like humans showing up in person, things like liveness tests that are provably resilient against AI. These are all considerations that we have to bring into the modern financial system. And also, we can do so without overexposing people's privacy. There's no reason why you have to give every single facet of data when you're applying for a financial account, an investment account, or anything else. It can produce a lot of friction and a lot of over collection, or even opportunities to discriminate based on attributes that are not relevant to banking or buying a financial security or things of that nature, right? So what are some pathways ahead, right? I think that it's also important to call out that this is reminiscent to the Office of Personnel Management hack that happened many years ago, but is still fresh in the memory of a lot of privacy advocates, about how a lot of background checks for federal employees were basically compromised and exposed. I think that we've seen companies have a good track record of managing private keys and cryptographic keys, but whenever we start to put a bunch of data into one big silo, it seems that it inevitably gets hacked. So is there a way, are there architectures that we can use that don't require that? So I think that there's a way that we can achieve this through giving the user more digital autonomy. We want, instead of people basically logging into platforms that are big silos controlling everything about them, that the platform asks the user, what data can I access? And the user has an opportunity to consent and understand what the terms are for that data to the right policies. Right? And it's really important that the tech and policy work in tandem. I'm going to be showing you some examples of what this future could look like and how it relates back to a lot of these networks that we've been talking about. One example is our partnership with the California DMV, where we have implemented the mobile driver's license to be a privacy-preserving digital identity that is controlled by Californians. It's provisioned to their phones. We issue the identity to the user. They choose which wallet they want to use, so you give the user more choice. And we put a lot of provisions there to make sure that it is surveillance-free and fully controlled by the user in terms of the ability to disclose data to the counterparty. Recently, the community colleges in California has announced their integration with the DMV wallet to give students access to benefits and other programs through this streamlined digital mechanism. Much more secure and convenient than trying to hold your driver's license up to the webcam and think about trying to scale a program to millions if you're requiring everyone to come in person, right? So this is about efficiency, this is about lowering fraud and streamlining the process. So this is what it looks like, just in case you want to see what some of the innovation in digital identity looks like. Please play the video. So you're at the community college website. This is a test credential only, and you're able to basically disclose the fields to the website for purposes of identity verification. Very fast if you think about how much you spend time on, maybe you've seen your kids use the Common App or fill out all these different forms for college applications, right? If we make things digital and convenient and secure and also privacy preserving, right, this gives us an opportunity to really streamline that while preventing a whole bunch of fraud and over collection risk. Onto another example, you need policy to go with the technology. So Utah is a state that's been leading on the policy innovation for privacy and also digital identity. Earlier this spring, Governor Cox signed into law Senate Bill 260, which talks about state-endorsed digital identity. It basically says that the state doesn't issue your identity because whatever the state can issue, it can take away. However, the state may endorse your identity in a way that is useful to you if you meet its requirements. And you can take that endorsement and do identity verifications and meet compliance requirements to basically be able to go about the world, right? So that model works a lot for people. And it is also very strongly aligned with a lot of the recommendations from the ACLU for digital identity programs at the state level, including the right to paper or plastic credentials. If you don't want to use the digital system, it's not forced onto you. If you want to be able to use it, it's not going to track you. Right? So these are constitutionally based protections in Senate Bill 260 that became the state code earlier this year. It binds all future digital identity programs in Utah, and many other states are interested in this model, and it is not one-sided. it's basically across the board. A lot of people think that this is a good model, and we're starting to see this policy innovation come about. We have all the technology that we want to protect privacy, but unless you have the backstop of policy to make sure that is the law of the land, it is really hard to ensure that people actually have privacy. This is an example that we demonstrated at the State Endorsed Digital Identity Summit that happened earlier this year at Utah Valley University. And we played the video, please. So in this example, you're going to use your state endorsed digital identity to open a bank account as part of FinCEN's customer identification program requirements. This is a flow that involves having email verification, SMS verification. One day we'll all move to passkeys, but we're not quite there yet. And then you'll also be able to enter your social security number, which is a requirement for banking at least. And at this next juncture, basically the old way to do it is upload these JPEGs of your documents, right? And then someone reviews it and everything, right? But the new way is to just have a secure session where you're able to transmit the selectively disclosed fields, right? As you heard about, it could be using zero knowledge or more traditional techniques, letting the user choose which wallet it comes out of and have the optionality as to what they disclose or not to meet the compliance requirements. And when that gets sent over, there's a digital signature that cannot be forged by AI, right? So that helps secure information get to the recipient that can then use that as digital evidence, right? So we're hoping that this can be seen as documentary evidence as part of the Bank Secrecy Act, because we believe that this is going to produce a more convenient, faster, and more fraud-free experience. So all this combined, where we have this growing momentum across the technology innovations, which by the way, are in over 17 states, there's a website called MDL Connection that you can go to and see all the active digital identity pilots. We have the policy as well getting figured out so that it is constitutionally based protections for use of digital identity. And we have a lot of the use cases, especially in the digital assets ecosystem, as you've seen here today, that require identification, right, in a streamlined manner. So all this puts it in the right direction. So what do we need from here, right? Well, fortunately, there's a body of work that I think is very important to bring up at NIST, the National Institute of Science and Technology. They have a program called the National Cybersecurity Center of Excellence, where they literally research how do we use digital ID for purposes of banking KYC, access to healthcare benefits, and also government benefits more generally, right? Those are, I think, the 3 research tracks. I recommend looking it up. I think that work is a collective effort. In the first research track with financial institutions, it was financial institutions talking to tech companies, talking to regulators and NIST itself. How do we find the best practices for industry there? And I think that it is a shoo-in for the digital assets industry for us to consider the work output from that group. I think also ensuring that we're able to get accurate numbers on fraud is critical, so we know where to apply a lot of the different research and techniques. So allowing for Treasury to collaborate with more technical institutions like NIST and come up with joint recommendations would be a really great way, I think, to lever the existing work that has happened and the great momentum we're seeing across the different states, because identity is being driven by the states. And I think that is the way that it will be in this country. I think it's better to keep it decentralized. It's harder to attack that way. You don't have one silo with everyone's identity that can be either misused or it can basically be compromised by adversaries, right? By keeping it more spread out and having it federated at the protocol level seems to be a much better approach. And finally, here's an example about the future that's possible, where we're talking about disaster relief payouts after, let's say, a hurricane or some kind of natural disaster happens, right? Let's play the video. And you're trying to get funds to people who need it, who need to buy basic necessities, right? What are ways that we can do that without opening the doors to massive fraud? A lot of these same protections can be used for financial securities to increase ownership of assets for Americans. So in this example, you see a web form, a very nice one, but it is pretty onerous to fill out all those fields, right? You have to put all your information in. You might have 2 dependents. So if you have kids, then you might need extra funds to make sure that the whole family is okay, right? And you might have some other important information like proof of income that they're requesting, right? So when we move to a world with digital wallets that are controlled by users, and they can basically share what they want to decide, you can scan that. You can choose what wallet you want to use for the experience. And you're able to see all the data before it goes out. Who's getting it? What framework is it being released under? For example, privacy framework in California or somewhere else. And being able to understand where the data comes from. When you have privacy-preserving digital credentials that are your driver's license, your W-2, your birth certificates for your kids, all in one place that is not surveilled, and you can choose how to share it, right? You can really breeze through these processes without incurring the fraud risk. So being able to get to that point, and you can basically receive the funds how you pick. We saw a lot of great infrastructure talked about today for networks that allow for privacy, right? You could get stable coins out of this. If you want to meet obligations for virtual asset service providers sending assets, you might have to go through these checks. But getting them through a stable coin could be a really fast and expedient way, right? So that you can have it right away and start spending it. So basically, we have an opportunity to modernize the financial sector using these technologies, policies, thoughts that basically extol American values, right? So I think that by combining this and understanding what is the interface that's going to be seamless, it's going to be secure, it's going to have the right kind of protections built in, right? That is how I'm hoping to move forward. I'm very optimistic. Thanks.
Thank you, Wayne. Well, we've heard from our speakers, and we want to give the audience a chance. We've got a few minutes before we break. If you have a burning question, feel free to. We've got mics in the audience, in the aisle. So now's our time to hear from you. I know I've asked a couple of questions. Anything that's burning, please do come up, and we will hear your question. And I see someone. Oh, I thought someone was just walking to the side, but please feel free to come on up. And our first person, yes. Do you want to say where you're from? Your affiliation? Is that mic working over there? Maybe you might have to press. There we go.
Hi, can you hear me?
Yes.
Hi, I'm Kristen Bose-Hayes, formerly of FinCEN, and my question is for Zuko. I was just wondering if you could speak to Zcash's efforts to meet regulatory obligations like the travel rule around things like messaging fields or shielded transactions or viewing keys or things like that, and whether you think maybe there's an opportunity for regulators to actually ask more of developers around privacy enhancing technologies via regulation, if there's an opportunity there, and whether you think your efforts have been a success. Thank you.
Turn it on. Press. Oh.
Okay, how about now? That was a big question. I'll try to answer one part at least. You asked, can regulators ask developers to do more? And I really like that question because I'm a developer who's written a lot of software, like uploaded it to the internet. But nowadays, Zcash isn't under the control of the developers anymore. It's under the control of the users. It's like Bitcoin, like you could ask a Bitcoin developer to write some Bitcoin code that would do something different with Bitcoin. Maybe it would raise the 21 million cap to 22 million. You could probably get a developer to do that, especially if you paid him, or if you're a regulator and you ask him to do it and he chose to comply. But you can't get the Bitcoin users to run that code. And so it is with Zcash. I can write whatever code I want, but I can't get the Zcash users to run it. I don't know if that helps, but that's my honest answer to that part of your question.
Yeah. What about, and I think maybe the question goes to others on the panel as well in terms of, well, what is happening, right? Is this a black and white issue, an on and off issue? Because it seems like what we've talked about here are varying ways to address risk. So I don't know if anyone wants to jump in.
Yeah, I'll say if the asset is run by the users, then I think, Zuko, you're completely right. If it's a different type of asset, let's say it's a bond issued by a corporation or a government, then a regulator can go seize that issuer because there's a specific issuer. I think there's a major difference between a kind of issuer-less assets and an asset issued by a given entity. I think the question follows more the asset issued by a given issuer, and it's more challenging for an asset that is issuerless to be followed the same regulation.
Yes, Jill, go ahead.
Yeah, maybe I'll just add that at least my experience of building these types of products in the space, most of the time you are interfacing with, ironically, a sort of intermediaries. So, if you're building a new blockchain with a new asset, you might be interfacing with the likes of Coinbase and exchanges who are giving you guidance on what they'll need in terms of things like view keys. And, if you are, I would imagine, products like Canton serving many enterprise customers, you'll probably be interfacing with them. And I think that there is a huge opportunity for net new products being developed today by developers. It's less relevant perhaps to things that have been existing for the last 10 years, but for the likes of FinCEN and regulators to engage directly with industry, certainly, instead of us having to kind of rely on what exchanges or other parties are telling us.
Other questions from the audience? Okay, gentleman sitting down right there, come right up.
Hello, I'm Charlie Chen from Taiwan Anti-Money Laundering Virtual Asset Association. So I have a question for Ko. So you mentioned that kind of a futuristic way we can balance compliance and privacy through like smart privacy. Like, so the smart contract deployer can deploy like measure to control this risk, to mediate this risk. But I want to ask more about like realistically how to actually managing this deployer to make sure that they implement sufficient parameters to prevent illicit players. Do you think it's rely on the regulator to kind of check on individuals, or it's rely on the infrastructure deploy to make sure that people deploy smart contract on the blockchain can be compliant with these regulations? Thank you.
I think it's going to be a combination of both, right? The developers, the businesses, the companies that are deploying the smart contracts, they need to understand their left and right lateral limits. So there needs to be some sort of guidance. But like I said in my speech or my presentation or my discussion, I guess it's not a presentation here, as you see. The key to all of this is programmability. When you have the ability to program smart contracts, you can meet whatever requirements are pretty much asked of you. And I think this kind of gets the question, or the previous question, the main difference in the state of Zcash is that it doesn't have programmability, right? You kind of get what you get. You can either get a shielded transaction or a transparent transaction.
All right, guys. So I'm just going to step in. This is still live. The SEC Roundtable. These are all good questions. A lot of good information that's being asked here. Now, why isn't my background showing? There we go. All right. Now, I just wanted to tap in and make a statement just based off of these questions, the responses, privacy in Zcash. Privacy in general is a big topic of conversation right now. And I'm not trying to be biased here, but midnight has just been screaming in my mind the entire time I've been listening to this. They're talking about programmability is the key. You just heard Ko say that. ZK technology, being able to leave things in and leave pieces of information out that you get to choose. Okay, holding on to your data, owning your own data, having privacy as an aspect. It's very important. This is the main driver of conversation right now. Knight does all that. I didn't really understand that at first. Charles Hoskinson said we need this. The industry needs a technology like this. Out of nowhere, Zcash came, started rising to the top. Privacy coins came out of nowhere in 2025. Well, now it all makes perfect sense. And I can't help but think of Knight. I mean, Ko just said in response to that guy, hey man, Zcash doesn't have programmability. Well, guess what? Knight does. So I mean, I don't know, guys. Let's currently take a look at it. All right, so I appreciate you guys tapping in. This is the Coin Zone. We just did live the SEC Roundtable. Okay. Now, Midnight on Cardano just launched last week, and it is still at around, what, like 6 cents? Let's see. 6 cents. Okay. We saw a high of 12, I believe it was, trading at around 6 cents, but this could potentially be a huge play for 2026 and beyond. Midnight is a cryptocurrency launched in 2025 and operates on the Cardano blockchain. Midnight has a current supply of 24 billion tokens with 16 billion in circulation. Now, if you guys want to learn more specifically about Night, well, guess what? We have a surprise for you. We have a Night ambassador we're doing an interview with this week on the channel. So stay tuned and subscribe to us in the meantime. Okay, if you want to learn more about privacy coins, if you want to learn more about Midnight, we'll probably have that out to you guys next week or so. So stick around. I'm going to be doing that interview this week. I can't wait to do it. Again, a Midnight ambassador. All right. So we're going to have some Night interviews for you. The BitTensor interview coming for you guys. And again, right now, privacy is huge, guys. Now, the SEC, the roundtable is still going on. We're going to take a break here. I appreciate you guys for tapping in. This is the Coin Zone. I'm Crypto with Paul, second live of the day. Appreciate you guys for joining, and we'll see you again soon.